And as expected, the turmoil in Turkey eroded appetite for risk on Wall Street as the U.S. stock indexes appeared set to stumble early on Monday. While looking at the benchmarks now, futures for the Dow Jones Industrial Average were up 0.36%, while those for the S&P 500 index traded 0.3% lower. The Nasdaq 100 futures shed 0.33%. Meanwhile, the markets in Asia skidded and the euro hit one-year lows on Monday thanks to the renewed rout in the Turkish lira. Japan's Nikkei lost 1.98% and China's blue chip index lost 1.4%, and Hong Kong stocks were down 1.6%. While elsewhere, the Kospi eased 1.5% as tech stock extended recent declines, with heavyweight Samsung Electronics pulling back by 0.77%. In Australia, the S&P ASX 200 finished the day lower by 0.42%. And of course, as we mentioned, the Hong Kong Hang Seng Index fell as the sectors recorded steep drops before the market close, led by declines in the services sector. And the South African rand is also feeling the heat from the currency crisis in Turkey. A plunge in the rand and a slump in the Mexican peso were symptoms of the growing contagion in the emerging market currencies today, as the financial turmoil in Turkey saps demand for developing nation assets. The rand slid more than 10% earlier in the day, hitting a session low of 15.7 to the dollar, but later recouped much of its losses to be 3.27% weaker at 14.54 to the dollar. In fixed income, the yield for the benchmark paper due in 2026 was up 18 basis points to 9.03%, reflecting weaker bond prices. The Turkish lira has lost more than 40% of its value this year, and worries over Turkish President Tayyip Erdogan's increasing control over the economy and deteriorating relations with the United States. Chinese officials have been mostly measured and moderate in their response to U.S. President Donald Trump's ratcheting up of a trade war with Beijing in recent weeks through his announcement of a series of punitive tariffs. But the mood on the street of Beijing and Shanghai is less or a little less accepting.
Many residents in Beijing and China said they are not worried, as U.S. President Donald Trump ratchets up of a trade war with Beijing in recent weeks through his announcement of a series of punitive tariffs. But there is division over how China should respond to Trump, with some arguing that Beijing should strike back at American interests, but others saying they didn't know what could be done. But perhaps most worried for American businesses selling in China. A recent minority of the people interviewed want to stop buying American products now. And some say they are already boycotting anything made in the U.S. Others say they will continue to buy American, but that could change in the future.
From the perspective of everyday needs, regarding this trade war issue, I don't think that I'm that affected. Is what I buy imported or made in China? Because I think for most things, the domestic supply can meet the demand.
For me, the trade war is great. That's because I receive my salary in US dollars, and since the US-China trade war started, the US dollar has kept increasing in value compared to the RMB. So I think it has really helped me. It's great.
I used to be more interested in American car brands, but now perhaps I'll have to give up that option.
If that was representative of the whole of China and words were turned into action, it might start to put a dent in sales of Apple's iPhones, Disney's movies, Starbucks drinks and General Motors cars, among other American products, and that's without any boycott being organized by the government or activists.
Let's take some earnings reports back here in Africa. And South African pulp and paper maker SAPI has reported a 12% drop in quarterly profit due to an increased depreciation expense following higher capital expenditure. SAPI, which sees 45% of its sales in Europe and 23% in North America, says profits for the period fell to $51 million from $58 million in the same period last year. Sales rose to $1.44 billion from $1.26 billion. The news has sent the company's share price tumbling over 5%. And here in Nigeria, listed agriculture and agro-allied company Okomu Oil has reported a slightly disappointed performance in its half-year results for 2018. According to its financial statement released to the market, Okomu Oil's revenue went up by 4% to 12.93 billion naira as at June this year, compared to 12.47 billion naira recorded the same period in 2017. Well, on the other hand, the company's gross profits slipped by 3% to 11.14 billion naira, while earnings per share lowered from 654 kobo to 623 kobo. Similarly, its profit before tax fell by 11% to 6.94 billion naira from 7.81 billion naira, while profit after tax dropped by 5% to 5.94 billion naira against 6.23 billion naira posted in the first half of last year. And in Malawi, the government realized a higher revenue from the country's major export crop, tobacco, which grew by 35% to $285.2 million this year, compared to last year's $210 million. The industry regulator, the Tobacco Control Commission, says the revenue could exceed $300 million by the end of the season later this month. The TCC attributes the increase to an influx of leaf imports from neighboring Zambia and Mozambique, which Malawi sold on. Figures released by Auction Holding Limited, that's the official auctioneer, showed that 164.3 million kilograms of tobacco had been sold at an average price of $1.74 per kilogram by Wednesday. Malaysian oil and gas company Petroleum Nasional has announced the acquisition of a 30% stake in Senegal's Rufisque offshore profound block. Well, this is the company's first project in the West African nation. The block is located in the vicinity of significant recent oil and gas discoveries, and exploration drilling activities will begin in 2019. Petronas says this is part of an upstream strategy to grow its exploration portfolio in West Africa, where it's operator of an ultra-deep water block in Gabon and currently looking to explore further in the region. All major Total will maintain operatorship of the block with a 60% ownership. And while oil prices are down today as trade tensions and troubled emerging markets cast a shadow on global oil demand growth outlook for 2018, however, despite the cautious mood in the oil markets, the bullish sentiment found some support from expectations that U.S. sanctions against Iran would restrict Iranian crude exports and tighten global supply. Benchmark Brent crude oil was down 25 cents to $72.56 per barrel in early trade, while U.S. light crude fell 25 cents to $67.38 a barrel earlier today. Meanwhile, industry data shows the number of active oil rigs from U.S. energy companies last week increased by 10 rigs to total 869, the highest level of drilling activity since May this year and March 2015. Still to come on the program, a review of activities at the Nigerian Stock Exchange. Do stay with us.